Welcome to the Deerwood Realty YouTube channel. I'm John Schenk, founder and managing broker of Deerwood Realty in St. Louis, Missouri. You know, houses are expensive, right? Like, things are out of whack. And I've lost lots of buyers lately, and I don't have many sellers, so it's not going really, really well for me. And I'm quite positive that's the way it is pretty much throughout the country now. Some people, yesterday I did a video about people cheering on a recession so that house prices would go down. Taking a different approach today, I saw an article on CNBC, and I wanted to go over it with you about how, what's going on, basically. And we'll just see if we agree with the things or if we don't. But let's get to it. It says, what will it take to make homes affordable again for millions of Americans? Well, that's a good question. It just starts out, it says, as mortgage rates reached a 23-year high last week, the cry went off across the markets and social media, is housing affordability dead? Has a version of the American dream, home ownership, kids' backyard barbecues, died with it? Well, I don't think so. I think we're at as bad spot in the market. I think that there's times when houses are expensive, and then there's times when houses are relatively inexpensive, which, to me, I mean, if you spend more than $100,000 for a house, it seems expensive. And I know that's crazy, but it just seems like houses are really, really expensive. I know that when I work with first-time home buyers, they tell me things like, let's say in St. Louis, the average price of a decent home right now is probably running around $350,000. But they'll tell me that they want to buy a house, and their budget is maybe $150,000. And so we go and look at the houses that are available at $150,000, and they're disappointed. Right? And they think that I'm not showing them all the houses available. But it's weird. It's like, you think if nobody pays that much for a house, the price will go down. And that's right. But always someone pays. Always someone pays. And so you get these stupid numbers, $350,000 to buy a home in St. Louis, just a decent home, not even, extraordinary. Look in places like California, it's not uncommon to have $1 million home. It's just odd. It's just odd. I've never thought that was rational. Anyway, the median family was already $9,000 short in August of the income needed to buy a median existing home, the association says. They're talking about the National Association of Realtors. And the recent surge in rates has moved another 5 million U.S. families below the qualification standard for a $400,000 loan. According to John Burns Real Estate Consulting, at 3% mortgage rates, 50 million households could get a loan that size. Now it's 22 million. I feel like that's looking at the issue wrong. It shouldn't be like how many families can qualify for a loan, because just because you couldn't qualify for a loan doesn't mean you should get it. Like, that's being house poor. The qualifying yearly income for a median price home in 2020 was $49,000. $49,680. Now it's more than $107,000, according to the National Association of Realtors. Redfin puts the figure at $114,000. It's one of those things where inflation is a killer, and we knew this, and yet our government and political leaders decided that was going to be okay. That was worth it for the risk. That it was worth the risk. I don't think it is. It says affordability depends on three big numbers, according to Yoon, that's the chief economist. With incomes rising since 2019, the bigger issue, I messed up, because this was important. Family income, the price of the house, and the mortgage rates. With incomes rising since 2019, the bigger issue is interest rates. So we disagree here, because with incomes rising since 2019, they've not held the pace of inflation. They've come close. I mean, if, let's just put it in numbers, if your wages go up 25 cents and inflation is $3, I mean, you didn't get anywhere. It doesn't matter if your wages increase. And so anyway, it says the bigger issue is interest rates. When they were low, they were papered over a surge in housing prices that began in late 2020, helped by people relocating to areas like Florida, Austin, Texas, and Boise, Idaho, to work in their old cities from their new homes. So right now is an admission in the article that there's a surge in housing prices. That surge in housing prices is inflation. That's what it is. It's not like all of a sudden people came to the market and were like, oh, we need to buy a house, and we never thought about it before today. No, it's inflation. It absolutely destroyed the housing market. It says now the surge in rates is crushing affordability even as incomes rise sharply, and housing prices mostly hang on to the big gains they generated during the pandemic, which will get my video shadow banned on YouTube just for that mention, which is great. Anyway, look, like it was getting out of the house prices are the problem. That's the problem. It's not the mortgage rate. The mortgage rate is a problem in the sense that you can't buy a home with it right now, but you would be able to buy, if the house was $200,000, you would have many more people that would be able to afford an 8% mortgage. It's the price of the house. At the current 8% mortgage rate, mortgage payments are 38% of median income. Moody's Analytics chief economist Mark Zandi said the mortgage rates has to fall 5.5%, or the median home price has to fall by 22%, or the median income has to rise by 28%, or some combination of all three variables. Well, let's look at it. The mortgage rate has to fall to 5.5%. I don't think that's so great. I don't think that's likely right now. Median price home has to fall 22%. I mean, it could fall, but it's not going to fall like in a month. Or the median income has to increase by 28%. Again, wages will increase because people are going to work and they're not, because of inflation, they're not getting anything out of their work. So that's not a problem. I mean, that's going to happen. It says what needs to change to make housing affordable again. It says a few scenarios using NAR data, which is the National Association of Realtors, to help illustrate how far affordability is from the average between 1989 and 2019 and what would be required to push it to a more typical range as the national average for the 30-year tick lowered 7.98% on Tuesday. I don't know when that was. I don't know. I didn't check the date of the article, but you're still right around 8. It says if home prices are stable, rates need to fall to 3.55% in order to be back to the historical average. Well, that's probably not going to happen anytime soon. If prices grow 5%, rates need to fall to 3.16%. If prices stay the same but incomes increase 5%, rates need to fall to 3.95%. A mortgage rate that stays around 8% means median home prices need to fall by 35% to $265,000. If rates stay at 8% and prices at current levels, income needs to increase by 63%. It's not going to work. That's not going to happen in that order. It says affordability became stretched partly because home prices rose 38% since 2020, according to the National Association of Realtors. But more important was the jump in average interest rates from 3% to as high as 8% last week. I don't agree. It was the 38% home price increase. It says higher wages are a plus, but not enough. Rising incomes will help, and median family incomes have climbed 16% to more than $98,000 since 2020. But that isn't nearly enough to cover the affordability gap without devoting a higher share of the household paychecks to the mortgage, said Zandi. Look, that's the issue. Wages aren't going to keep up. They're just not. It says not enough new housing in America. Now, this is an interesting argument. I've said that, your typical investors will sell their houses if they're not making money on them. And there are signs that could be the case. If you look at places that were overheated markets like Phoenix, for example, there's plenty of rentals available. So right now, this is as of November 7th of 2023. So it could be different in the future. It says the biggest reason that so few homes are up for sale is the laws of supply and demand aren't working normally, which I agree with. Even with demand hit by affordability woes, buyers who are out there have to compete for so few homes that prices have stayed close to balance. Boomers are doing what they said they were going to do. They're aging in place, and Gen X is locked into 3% mortgages already, so it's up to the builders. I just disagree. I think housing policy in the United States is pretty messed up. And just from this one example, why is a corporation that can have millions and millions of dollars behind it, why is it competing with a family, a group of wage earners It just doesn't make any sense. And that's what we saw during the pandemic. I was getting offers from like BlackRock, companies aligned with BlackRock on my houses when I had them listed. The typical American consumer can't compete with those behemoths. Says the builders are kind of a problem, said Redfin economist Daryl Fairweather. They've been boosting profits this year. Oh, those greedy home builders. Tracking the industry is up 41%, but Fairweather said they've barely begun to address long-term housing shortage. Freddie Mac estimated 3.8 million homes before the pandemic, a number that has likely grown since. Builders have begun to work on only 692,000 new single-family homes this year and 1.1 million, including condos and apartments. So it'll take nearly 4 years to build enough houses to rebuild supply, and that leaves out new household formation. Meanwhile, apartment construction is already beginning to slow, and some builders, though not all, are pulling back on mortgage buydowns and other tactics they've used to prop up demand. Pulte Group CEO told CNBC this week it had been buying down mortgages to an effective rate of 5.75%. Well, in this paragraph, there is a nugget. It says, meanwhile, apartment construction has already begun to slow. And some builders, though not all, are pulling back on mortgage buydowns and other tactics they've used to prop up demand. Why are they slowing, right? If all the supply is needed, why aren't the builders building, right? And you say, well, John, because interest rates are too high, they can't borrow money and make a profit. What if they see something that that's on the horizon and they're just trying to survive? I know that sounds crazy, right? Because they had really profitable years, but what if they're just forecasting a slowdown in the economy? Says there are reason to believe more buyers could materialize, right? And there's always a bullish case for home buying. Duncan said the millennial generation is just moving into peak home buying years now, promising to add millions of potential buyers to the market, with the biggest annual birth cohorts reaching the average first-time purchase age of 36 years around 2026. If rates do begin to decline, Fairweather predicts that will bring more buyers back to the market, but inevitably push prices back up towards previous peaks, which there had been signs of earlier this year when mortgage rates dipped 6% in early March. We need a couple of years more building at this pace, and we can't sustain the demand because of high interest rates. Well, I don't agree with that because I don't think we're going to get more building. So in that case, you've got a problem. And I do think that when rates go down, you're actually going to see more investors jump in and buy houses. I think that everyone just believes that house prices always go up. And so that's what they're going to do. It says the Fed and bond markets are big problems. Now, this is real. I do believe this. It says there's two problems with the mortgage rates right now. One is a Fed determined not to declare victory over inflation prematurely, and the other is a hypersensitive bond market that sees inflation everywhere it looks, even as the rate of price increases throughout the economy has dropped markedly. Well, that is the author's opinion, which is fine. The argument here is that you would, the argument is basically that the inflation is still with us, but not as much as you think. But you just go to the grocery store and you can see right away that inflation is massive. It says the biggest reason mortgage have surged of late is the bond market, which pushed 10-year Treasury yields up by as much as 47% for a full 1.6 percentage points. On top of that, to traditional spread, and this is where the real issue is. The traditional spread between the 10-year Treasuries and mortgages had widened to more than 3 percentage points. 1.5 to 2 points is the traditional range. And so what the Fed has said as this is going on, and they're like, look, we don't have the rates up that high. We're not the ones doing it. It's the bond market. It's the spread in the bond markets, and we don't control the bond markets, which they have some input in the bond markets. It says, even so, few economists or traders expect the Fed to push rates lower to help housing. Do you remember just a couple weeks ago, the National Association of Realtors, Mortgage Bankers Association, and National Association of Home Builders wrote a letter to the Fed and says, could you please lower rates because we're dying? I don't know if the Fed wrote back. But anyway, I don't see the Fed. The Fed's trying to fight inflation. There's inflation everywhere. They're trying to soften the job market. So It says to get affordability back to a comfortable range, it will take a combination of higher wages, lower interest rates, and stable prices, economists say, and that combination may take until 2026 or later to coalesce. Let's just get it out there. If the Fed's goal is to soften employment, how are wages going to increase in the United States across the board? So that's not going to happen. And then as far as stable prices, what are we talking about here? The houses prices are pretty stable. They're just very, very high. So it says the market is in a deep freeze. I might have read that, so I'm not going to do it. I did read it. I'm sorry. I didn't mean to repeat. Anyway, I thought it was a fascinating article. It's like, this is what it's going to take for things to be affordable, and we can't do any of them. We can't or won't do any of them. If you made it this far, I mean, 16 minutes in, I appreciate it. Look, I had like something going on with my throat. I had like a cough I needed to do, but I didn't want to do it on camera, so that's the way that shows up. If you do me a favor, if you've made it this far, would you please hit the subscribe button? I've had a lot of subscribers lately, but I just feel like we can do better. So with that, I'm going to head on out. Thank you for watching. Thank you for listening, and I will catch you on the next one.